Welcome to this Click Explains Finance video. This week I want to take on what is unfortunately a topical topic, and that is the issue of fund liquidity crunches. We've seen it with the Woodford Fund early in 2019, M&G's flagship commercial property fund hitting problems. So how can investors avoid a fund liquidity crunch, and what does it actually look like? Okay, so the background is what? Well, Neil Woodford's funds have now closed, and that's demonstrated the problem with open-ended structures in general. Open-ended structures are the way that many funds are actually set up, and the M&G commercial property fund is another example. They're pretty universal, and that's because originally they were set up to, you could argue, give certain benefits to retail investors. That was the marketing line, if you like. They're regulated and so on, so they get the FCA's approval. But the reality is investors need to know how they work and understand some key risks. And also be aware of the alternatives. So although these are marketed very heavily, the open-ended structure is sort of marketed almost as though it's the number one option for retail investors, there are other ways of achieving a similar end goal, perhaps with less risk. So open-ended nightmares, I've called them. Now, I'm not saying all of them are a disaster, but there are some question marks over the way things work now. So open-ended funds are fairly unique. They don't work like other funds. Now, what I mean by that is they're set up in a certain way, which I'll come back to in a moment, that's designed to offer a degree of investor protection, but actually, if things go wrong, can leave investors a bit exposed. The way they're supposed to work is meant to be secure and safe, and the reality is, as I say, things can go wrong, and I want to look at three. So, what have we got? Poor disclosure is one, gating is another, and fees is the third. Take each one in turn. These are not the only what can go wrongs, but they're three of the biggies. So disclosure, first of all. What are they not doing? Well, here's the problem. An open-ended fund will have a mandate, equity income or commercial property. So there'll be something that tells you, as a marketing strapline, what it does. But underneath that, there'll be a series of investments. And the amount of information you can get on those investments can be quite small. Usually the big ones, you can get information on, the top 10 holdings and so on. But the smaller ones, you may not be able to. And there's where the risk lies. The manager will justify that by saying, well, if I told everyone what I did, then basically they'd simply copy me, my secrets would be lost to the world, but actually it creates some dangers. So investors may be somewhat in the dark about what's actually under the bonnet beneath that broad mandate. And this tail risk is actually what ultimately did for Woodford's main flagship fund. He simply couldn't sell assets to a sufficient level of volume to repay sellers who were demanding their money back from the fund. Now, gating is what a fund manager will do, and we've seen this with the M&G Commercial Property Fund at the end of 2019, when they think, actually, I've got a problem here. I actually need to buy myself some more time. And the way I'm going to do that is I'm going to close the fund temporarily, stop buyers and sellers participating in, for example, dumping units. I'm going to stop that for a moment, get myself some breathing space, try and reorganise my assets so that I can keep everybody happy, sellers in particular. Now, an example. So what's going on here? So imagine you've got a fund with assets of 100 million. Some of you may have seen this before if you watched my Woodford video. There are 100 million units available to buyers and sellers, so people who want to invest in this fund, and the applied unit price is therefore £1. And that's a feature of open-ended structures, unit trusts and so on. There is a direct link between the assets held, the number of units and the price. Okay, as this rises and falls, so will that, because the two are linked. And there's normally a valuation point where investors find out what the new unit price is. Now here's the problem. Imagine, under the bonnet, that you can't see necessarily, is 20 million of the fund, slightly extreme you might argue, is in liquid stuff that's easy to sell, shares for argument's sake. 80 million is in not so easy to liquidate assets. Now you might say, what's the problem? I mean, basically if people phone up wanting to sell units, the fund manager can surely sell some of that. Who's going to know any different? But what if you get sellers wanting to dump 40 million of units? I made the numbers quite big here. Suddenly, the fund manager doesn't have enough liquid assets to get rid of. So what do they do next? Try to raise the money over here, all right? Or potentially say, actually, I've got too much selling pressure. I need to actually put this whole thing on pause, gate it, stop anybody participating in unit purchases and sales for a while, and see if I can reorganize my portfolio, raise the cash I need to satisfy sellers, for example. So that's what we've got here. The manager could sell sufficient assets to meet redemption requests. Everybody's happy, the fund moves on. Or sufficient assets cannot be sold and trading in the fund is suspended. Or in a worst case, and we have seen this relatively recently, the fund may be closed. In other words, once word gets out that the fund's been gated, suddenly it becomes the target for people trying to work out what the fund manager's holding, what they're trying to sell, and naturally prices start to move against them, the market starts to turn against them. So it can create a self-fulfilling prophecy. Not in all cases, but gating is not a good thing from an investment point of view. Now, most at risk, property funds for sure. If you think about the nature of certain commercial property funds, they are investing in a lot of quite illiquid assets. So my balance of liquid to illiquid on the last slide, there's a 20-80 split, may not be quite so crazy in that world. Bond funds. Now there's another situation, another market, where if you get liquidity risk wrong, things can go against you quite quickly. You get a rush for the exit, as it's called, as sellers realise that getting money back is going to be difficult. And then of course, Woodford's woes have highlighted that even in a supposedly more liquid market like equities, you can also get gating risk. You can get fund suspension and closure risk. So there are other types of fund out there that could suffer, but these are three big categories, with some people a little bit surprised about number 3, but as I say, that tail risk, that temptation to invest in less liquid securities can be what puts equity funds on the board. Now fees. I said there were 3 things I was going to take a look at, so what would be the third? And it's fees. When the first unit trust was launched, and these are old vehicles now, 1935, you have to go back to find the first one, it charged an annual fee of 0.5%. It was a visible kind of all-in fee. Nowadays, some funds charge multiples of that, so it's ironic with technology and so on, funds have actually managed to get more expensive, not less expensive in a lot of cases, and what's worse, it can be quite hard to work out how much you're paying in total anyway. The industry is set up in such a way that determining exactly what you have to add to what to get your total fee is quite difficult. So with the fund alone, you might have initial fees, maybe waived, for example, but you need to know that. Annual management charges or fees, exit fees are possible, and even on the old style unit trust, a bid to offer spread. So as a unit buyer or seller, a difference between the price at which you buy and the price at which you sell. And all of those, added to other things like platform fees and so on, can add up to quite a big, murky picture for investors to try and piece together what they're actually paying for these things. And it's, in quite a few cases, going to work out at more than 0.5% where we started. So, 2 solutions. I'm going to keep this fairly brief because this opens up arguably some more Killick Explains videos, but let's keep it brief here. So what are the solutions? The FCA have introduced new disclosure requirements around liquidity. So they've said, basically, what we could do is force funds, when there might be a liquidity issue, to give more information about it. And they've created a new category of open-ended investment company, funds investing in inherently illiquid assets. Yeah, not the snappiest line they've ever come up with there. But for sceptical fund investors, there are other possibilities, because I'm not sure how many fund investors will be fully convinced by more disclosure. So what else is there out there? Well, ways to invest, I've called the final section. Essentially, open-ended vehicles with a mandate that minimises liquidity risk could be one way forward. There are funds out there that have said, we are confident, we're happy to disclose what we invest in, and nothing in there is illiquid. Well, easy for them to say, but markets can change. Investment trust companies. Now, these are a different type of structure. These are funds that basically buy into shares listed on the London Stock Exchange, and they themselves list their own shares on the exchange. So you take away that gating problem potentially, but you do introduce the possibility of big discounts to net asset value or even premiums. And in a bear market, those discounts can accentuate losses. And then finally, direct equity portfolio. So why not, if you're looking at a fairly simple strategy, why not put something together which basically invests in a series of large liquid equities that you can see. The bonnet, if you like, is raised rather than closed, as it is with funds that are designed off the shelf, and that will give you some of the exposure that you want with larger sums potentially, rather than having to go for the structure, as I say, on the left-hand side in particular, that doesn't give you that visibility about what's actually in there. To find out more, particularly if you're interested in that third option and haven't heard much about it from me so far, then it's editor@killick.com. And if you'd like to find out more about funds and equity investing in general, killick.com/learn. Down this side, you've got a shares tab and a funds tab.